Hello everyone and welcome to the Case chat session. My name is Dean Rogers and I'm the Senior Analyst with Case & Company. In today's chat session we're going to be going through the third part of a four-part series on Kase Wave Analysis. Now we all know that trading is risky, so here's our standard disclaimer. But you should know also that these Case chat sessions are geared towards educational materials. This is in no way any type of consulting, nor is there any advice being given. So in parts 1 and 2 of Kase Wave Analysis, we went through picking waves and calculating the Fibonacci wave projections. In this third part, this is really where the rubber meets the road. What we're going to do here is we're going to go through identifying confluence points. We're going to use the wave analysis and the waves that we picked to actually identify the points at which key support and resistance may reside. Our main goal or our main learning objective is to take the grid of Fibonacci wave projections that we put together in the last session, in session 2. So if you haven't seen that one yet, it's going to be key that you watch that. Using that grid, we're going to go through and identify confluence points that would indicate where key support and resistance are for a given chart. Now to do that, there's a couple of steps that we're going to have to go through. We're going to have to remove some wave projections that have already been met or exceeded. We also want to calculate a target range. So this is kind of the cluster size. We're going to demonstrate the ability to identify the clusters of targets. Now in this presentation, we're going to do that by hand. However, this is something that could be computerized. We've actually computerized it internally and in our Case Outlook program on Bloomberg. So it's a labor-intensive process, but it's well worth the work. And then finally, based upon the confluence points, what we call the number of finds, or how confluent that target is, we should be able to make some determinations, or at least initial determinations, on how important the various support and resistance levels are. So let's talk a moment about what is confluence. What is the idea of confluence? And really this simply can be defined as a cluster of wave projections within a given range. Now that doesn't mean a lot on the surface, but when we get down into it, what we're going to really be doing is looking at a number of waves, their wave projections, and clusters in a target or in a target range. So let's say, for instance, we have 10 waves that we've picked from a chart that we think are important. And for each of those 10 waves, we've done 9 Fibonacci wave projections. So that's 90 total targets. It's a lot to work with. What we're going to do then is we're going to distill that down by taking out projections that have already been met or exceeded. So that might cut it down from 90 to, let's say, 50 targets. And then out of those 50 targets, we're going to look in a range. Let's say we're looking at crude oil, which we're going to use as an example today. We're going to look at a plus or minus 35-cent range. So we're looking for 70-cent clusters. And so in those 50 remaining projections, we're going to find how many targets we can fit into those clusters or those buckets to see how confluent each of these projections are. So for instance, out of those 50, 10 of those 50 might be in a range, a plus or minus range of $80. And another 5 might be $75, and another 3 might be at $70. So these are the confluence points in the analysis. Generally, these will help us to identify strong areas of support or resistance, and they're usually confirmed by other factors. We use factors like retracements, candlestick midpoint and open, the Case dev stops, moving averages, so like the 50-day moving average or the 200-day moving average, and trend lines. The first step in all of this is picking a range. We need to know what cluster size we want to use, and that's going to vary dependent upon the market that you're looking at, and also the length of time or the detail of this analysis. How detailed do you want this analysis to be? So for a wide range, if we use a wide range, that's going to be a longer term view. If I want to know where prices, where key support and resistance are in the next 3 to 6 months, I want to use a fairly wide range. However, if I need to know where the market's going to go and where key support and resistance are in the next 5 minutes or 50 minutes, I need to use a narrower range, a smaller range for a short-term view. A good starting point is 25% of the daily average true range, and I'll usually look at the average true range over 30 to 100 bars. So here's an example of what we're going to use today. This is December crude oil 2014 as of October 3rd, 2014. Now the average true range over the last 100 days on this chart at that point was $1.34. 25% of that is about 34 cents. Generally, in my week-to-week analysis of crude oil, of WTI, I use a 35-cent range. So that's what we're going to use today, is a 35-cent range. Now before we switch over to some charts and looking at our spreadsheet, just want to remind you all, we have two websites, casestatware.com and caseco.com. We also have gotten very active on Twitter recently, so please follow us at Caseco. So a lot of great information. If you guys have any questions, you can post them on Twitter as well. Or you can always email me, dean@caseco.com. Okay, so we'll start off with our move down on the December WTI chart from 106.81 down to 81.95, back up to 103.66. And then we'll look at the subwaves down on the daily chart from 103.66 down to this low that had been made on October 3rd, which was 87.22. Now we already picked these waves in sessions 1 and sessions 2 of this series. So for instance, here's that first wave down, 106.81, 81.95, 103.66. So we can get a quick peek at it, 106.81, 81.95, 103.66 on the weekly chart. And these are the 9 core Fibonacci wave projections. Now for those of you that are not familiar with the 9 Fibonacci wave projections that Case uses, we covered those in detail, including the factors that we use to calculate those projections in the session 2 or part 2 of this 4-part series. So I encourage you to go back and watch that if you have any questions. Now, once we have our waves laid out, the first thing that we want to do is we want to start cleaning up our wave projections. There's really 2 steps to this. The first is taking out the repetitive corrective projections. For those of you that recall the first and second lessons in this series, there will be times where you will have, let's highlight these, there will be times that you have repetitive YZs for various waves. And the corrective projections are calculated off the YZ leg of a formation. Therefore, you will get repetitive projections. Okay, so we can see here where this wave, the YZ is 91.51, 94.42, that's the same with these few waves down here, and they have the same projections. And then here we have our 89.13 and 93.82, so they have the same projections. We want to take these out because we don't want to double or triple or quadruple count them when we're actually going through and looking for confluence points. So I'm just going to delete those altogether. You can mark them out however you want. I'm just going to take them out altogether. The second thing that we want to do is we want to actually go through and take out any projections that have been met or exceeded. Now we do this by looking at the wave, and then from the Z point of the wave, looking at the lowest low after that point. Now it just happens to be that in this case, after 103.66, the low is 87.22. Now because we don't have different zones, we haven't gone up and made, come back down or anything like that at this point. So at this point, all of our waves, the lowest low after the Z point is going to be 87.22. So this is a pretty simple cleanup.
What we're going to do here is we're going to look and we're going to mark out, and you can do this in any number of ways. In our programs internally, we strike them out. I'm going to, for simplicity's sake, mark them out by coloring them red. This means that this wave projection has already been met or exceeded, and therefore it's no longer valid for our analysis, for finding confluence points. It is valid for our analysis in the sense that meeting or exceeding various projections give us important clues as to where the market may go from that point. So here we can mark out anything that is less than 87.22. We're going to go ahead and mark out in red. In fact, this one here, this 87.50, is right in line with the 87.22 plus or minus our 35-cent tolerance. So if I look at 87.22 plus 35 cents, that's going to be right around this 87.50 level, meaning that this wave, 103.66, 97.32, 100.35, met its P3 projection at 87.22. So that gives us a little bit of a clue as we move forward. So we'll continue to go through here and mark out anything that's less than 87.22. Again, the key to this is always looking for the lowest low after your Z. It just happens that in this series of waves, just the way that this market is playing out, the lowest low after all of my Z points is 87.22. So I can continue to mark those out wave by wave. Now I've already done some of that work to save us some time. So I actually have everything here marked out so that we know which waves are valid or which wave so that we know which wave projections can still be used for this analysis. So the next step is actually identifying the confluence points. Now, we're doing this by hand, and this is a labor-intensive process. However, if you keep this analysis up on a day-to-day and week-to-week basis, I do our analysis, I update it once a week at least. I might update it a few times during the week. You can even update it every day. Again, this depends upon whether or not you're looking at a longer term forecast or a shorter term forecast. If you're looking at a shorter term forecast, it's obvious that you need to update this analysis more often. That said, we're using a plus or minus 35-cent tolerance. So what we want to do is we want to find waves or projections within that 70-cent cluster. But we have to have a starting point. And the way that I like to do this is I look at my important waves and I try to get a sense of where the market's going based upon those waves. So the largest and most important wave that we have on this chart is the 106.81 down to 81.95 back up to 103.66. That wave just recently met its smaller than target. Now, based upon wave studies that we've done, and this is very true for short-term waves, not as true for longer-term waves, but generally speaking, when a wave meets its smaller than target, or its 0.618 phi prime projection, it will extend to at least its equal to target. So I have a very good idea here that the market's going to probably extend to the 78.80. So I want to start looking for waves that are right around plus or minus 35 cents, and I might expand that or contract that a little bit, that range, since that's a very important target. Now, the second most important wave on the chart when we start to look at the daily is going to be this wave down 103.66 down to 89.13 back up to 93.82. That's because this portion of the wave, or of this move down, is the largest correction. Therefore, it's very likely that we could have an A, B, C formation that's in progress. Okay, so what I want to look at is what is the smaller than target for this wave A, what is the equal to target, and so on and so forth. So if I look at that wave, 103.66. So this was one of our important waves here. And I look at this 103.66 down to 89.13, 93.82. 84.80 is important, so that I might color that. Let's make sure that this is yellow. Sorry about that. Let's make sure this is where we might color this purple. And then this one here, 79.30. Okay, so we have the 79.30 and the 78.80. Now that's, within 50 cents of one another, so that's a plus or minus 35-cent range. That's right around $79. So I can look at that and say, okay, I have a target of $79. Right now I'm looking at a 35-cent range, and so far I have 2 finds. But I can start looking at that 79 plus or minus 35 cents, and I can start scanning through my various waves for anything that's right around that. Now, here I have a 79.80. I can look at this here, but that's not quite within the range of this equal to target. That's $1 away. Now, if I increase this to 50 cents, I could capture that. Now, the wider I go, the less precise my target becomes. But at the same time, this is such an important target. I mean, look at this. Our 2 biggest and most important waves project this $79 area as the equal to. Really one of the most important projections. So, okay, I might expand this out a little bit, and this is discretionary. There's no hard, fast rules here. I'm not saying, use a $3 wide range if you're looking at crude oil, unless maybe you're looking at what's going to happen over the next 5 years. Okay, if I come within $3 of what's going to happen in the next 5 years, I'm pretty happy. But in the next 5 days, or in this case, maybe even out a couple weeks, I want to be pretty precise. So I'm going to go ahead and expand this a little bit, but I won't really go beyond that 50 cents. So I've got 3 finds now. And I can continue to go along and look for things like if I went out to this 80.10, yes, I can come down to the 79.30. That's still around 79.70. That gives me a 40-cent range, but I lose my 78.80, and I really want to keep that one because that's the most important wave projection. So I can continue to go through here. Here's a 79.30, and so on and so forth. Now, I can look at that point. Here's a 79.20, and we can continue to look for the confluence points. So 1, 2, 3, 4, 5. So we've got 5 finds so far. I'm sure, in fact, I know that there are others on here. But let's kind of move on for a moment and look at this 84.80 because that's going to be an important level. Right now, this market at that point was at 87.22. So we know that 84.80 is going to be one of our next major targets. Because if the market takes out 84.80, and realistically, once it meets 84.80, the odds are going to increase for a decline to this 79. And at this point now, this is a 79.30 target because we actually we widened our range. So we're looking at 79.30. Okay. But once it meets this 84.80, we may see a correction from that point. We may see a bounce. That could even be a bottoming point. But it makes the connection to 79.30. So from there, we need to look at, where's the confluence around 84.80? So we can start to search through, okay, we can look at 84.80 to 85.80. Again, we can widen our range to 50 cents, but in this case, this is close enough that I don't really want to do that. This is a near-term target. The $79 level, 79.30 level on October 3rd, so over a month ago, from the time that I'm recording this, it was still a pretty far away target, still about $8 away. A good 10 to 11% of price. So the likelihood of meeting that in a week was pretty small, but the likelihood of meeting 84.80 was pretty good. And we can see here's an 85.10, so we can make that purple. We can look around and see what else we have. I'm sure you guys are seeing these as I'm going through, but this is what you do. Okay, and like I said, it's labor intensive, but we have programs internally. We've created modules or macros to do this for us in Excel. We also have programs in Bloomberg called Kase Outlook that do this work for you. And if I get enough demand for it, so I'm encouraging you to email me, dean@kaseco.com, right on our website. post on our blog, post on our forum, post on Twitter at Caseco. Tell us, hey, Case and Company, Dean, Cynthia, I want your forecasting model. The more demand we get, the easier it's going to be for me to plug resources into doing that development. So right now we're trying to build that awareness and build that demand. So please let us know. I know that there's already others of you out there that watch these on a regular basis that have told me you want it. We're going to keep pushing. All right, so we've got an $85 level here. So we'll continue to look for these confluence points. So we can say, okay, well, our lowest is 84.80, our highest is 85.30. So we might have something right around 85.10, within a 35-cent range. And right now we have 4 fines. So we'll just continue to build that. Now, I've actually gone through this already. Again, did this work ahead of time just to save us some time here. And this is what I came up with. Now, I use slightly different colors, 79.30 here, 50-cent range, 6 fines. That comes up with here's our equal to, here's our equal to here, the same waves that we were looking at earlier. We can also look at our 85.20, okay, came up 6 times. So we call these fines. The fines are the number of times that a wave projection shows up in this analysis. Generally speaking, the higher the number of fines, the more important the projection. It's not always true, but generally speaking, that's true. So in this case here, we have 82.60, for instance, within a plus or minus 40-cent range. Comes up 7 times. So that's going to be a very important level. So is 85.20. 79.30 we know is our key level. All right. So at this point we can start to put together, not only do we know now where the important support points are, but we can also start to garner some information about how this move might unfold as it matures. Looking at this market, I am bearish. The market's coming down. It's met 87.22. That's just below the smaller than target of our large wave down from 106, from the 106 level, our 106.81. So we've already met the smaller than target. I'm really liking this 79.30 target at this point because that's the equal to, but I know that that point on October 3rd, it might be another few weeks before we see that 79.30 target. Once it breaks that 79.30, I got to start to, first off, to get to 79.30, we've got to get through this 85.20, which is the smaller than target for the large wave down on the daily chart. Okay, that was our 103.66 down to 89.13, 93.82 that we labeled as our wave A there. In actuality, it's A prime of C. This would be wave A. So what we're looking at is 84.80, which is right in line with our 85.20 plus or minus 40 cents, makes a connection to this 79.30. We've got intermediate support sitting right around 82.60, so we know that, okay, these are potential pausing points for the market. But really, once it breaks this and in actuality meets this 85.20, we're going to probably see this market extend down to 79.30. So once it gets to 79.30, okay, what's going to happen after that? If it breaks 79.30, our next big target is 73.70, which was a reasonably confluent point. It came up with 2 fines. Now, as time goes on, these lower targets might become more confluent because new waves will form. So as I update my analysis, this 73.40 might become more important. But right now, that's one of the next targets that I would be looking at upon a break lower or close below 79.30. Now, 79.30 is a huge point. I would more than expect to see a retracement there. People always ask me, Dean, where's the market going to bottom out? Where's the bottom of crude oil? Or where's the bottom of gas? Or where's the bottom of X, Y, or Z, or the top? Look, I'm not in the habit of catching falling knives. I can make a good, solid, educated guess. If I tell you where the bottom is, it's an educated guess, and it's a well-founded guess, but it's still a guess. So what I can tell people, and what I usually tell people is, look, a point like this $79, where it's the equal to target for the 2 biggest and most important waves on the chart, is a potential bottoming point. This is a potential stalling point for the market. I would expect to see a correction at 79.30. However, until the market recovers from that point and gives me some inklings of life in this market, some indication from a technical standpoint that a recovery is underway, overcoming the 38% retracement of the move down, candlestick formations, geometric patterns, something, in addition to just meeting a very confluent and important support point. I want to know, then at that point I can start to shift my bias to positive and say, yes, a bottom's been made. Okay, this recently happened in natural gas. We knew that like right around 355, 360 was a very key point. Market fell to 362. The actual prompt month moved to 354. The December contract 362. A V bottom for spike. Okay, market's made its bottom now, at least for this winter. And now we're going to continue to move up. We may consider, break into a consolidation range for a while because it moved up a little too far too fast. But nonetheless, I can now confidently say the market has made its bottom. We knew ahead of time that the 355 to 360 area was very important, that was a potential stalling point, and we had even indicated in our analysis, our week-to-week commentary, that was a potential bottom. We didn't call for it as a bottom, but we said it was a potential bottom. And that's the same type of thing that you can do here. Okay, I'm not trying to disparage the analysis, and I'm not trying to say that people that are calling for bottoms or calling for tops are wrong. It's just not my philosophy. So, I knew at this point, I'll get off my soapbox now, I knew that 79.30 was an important point, and if it breaks it, we're probably headed towards the 73.40, and more than likely 70, or the 69.90. Why? Because that is the larger than, or the 1.618 fee projection for our largest wave down from 103.66, and the intermediate, or the 1.382 projection for the wave down from 106.81. All right, so I can look at this market, say it's very likely that the market's going to test 85.20. There's an extremely good chance that it's going to test 79.30. And if it breaks 79.30, I would expect to see 73.40, and more than likely at that point, 70. All right. Now, these other sub-waves help to confirm the confluence and give us other clues, and these may become more important as time goes on and the move down matures. So, at this point, we've gone through, we've done analysis. We would do the same type of analysis for up moves. We're only working on the down moves today. The up moves in crude oil at this point were, they were projecting well above $100, so they weren't really telling us much. So we have to resort to other factors like retracements, candlestick patterns, geometric formations, moving averages, depth stops, and so on to tell us where resistance levels are until a move up starts to form. If you have any questions, comments, concerns, please email me, dean@kaseco.com. This is very powerful analysis. We've been using this for over 20 years in the energy markets. For the last 5 years, we've really expanded out into other markets using Case Outlook on Bloomberg. I've been doing this type of analysis since I learned it, which was almost, at this point, almost 15 years ago is when I started learning it, and really started to master it maybe 10 years ago. So I'm not saying it's going to take you 5 years to master it. It's just work with it consistently, work with it over time, update this analysis. And again, if you have questions, feel free to email me, dean@kaseco.com. For those of you, you can call me, and then also, shoot us an email or shoot us a tweet to us at Kaseco. All right. We also have a blog and a forum. I'll be posting these things to on a regular basis. And on the forum, you can ask questions there. It's a great place to chat with the community. All right. So thank you all for attending. Next week we'll go through the last session of the 4-part session, and we'll look at kind of applying this to our trading techniques, how we can use this analysis to help us make decisions on where to get in and where to get out of the market. All right. Until then, thank you very much. Have a good one.